All right, we are starting with the day 19 activities. So this is the segment of class for my evening class that talked about stock dividends and stock splits and the quasi-reorganization and the running the activities through the income statement and the statement of comprehensive income. So that's where we're headed. So we're going to start off with the stock dividend idea, and this slide gives you a lot of information about the stock dividend. Here, rather than distributing property or cash to our shareholders, we're actually going to send them more stock. So when we do these stock dividends, it's going to change the number of shares that we have outstanding. We give it a stock dividend. So GAAP has some rules about the way we manage the recording of those stock dividends. There's no cash sent to shareholders. They're going to get additional stock. GAAP requires different measurement based on whether or not the stock dividend is small, meaning that it's less than 25% of the shares outstanding, or large, which would be greater than or equal to 25% of the shares outstanding. So for this example, there are 5 million shares outstanding, and we say we're doing a 20% stock dividend. The percent refers to the 5 million. So the first question is, which type of stock dividend are we dealing with here? Is it a small or a large stock dividend? And I'm pretty confident that you can recognize that 20% is smaller than 25%. So this is a small stock dividend because it is 20%. Okay, and it's less than 25%, all right? So I ask, to do an entry, and what I told you in item 1 was how the entry is going to work. If it's a small stock dividend, we're going to require that it be measured at market value of the share. So the problem gives us the market value, and once I have a market value, I can do an entry similar to what we did with issuing shares originally. So to prepare the entry, basically what is going to happen is my common stock is going to increase. That is not what I wanted to start with. I had my idea and I wrote the wrong thing. All right. I'm going to know that my common stock, that's going to be a credit, is going to increase. And it's going to increase at $1 par value, and then I'm going to have some additional paid-in capital on that common stock. Okay, so I'm valuing this dividend at market value, and my debit here could be either retained earnings or a dividend account. I'm just going to use retained earnings in this example. So we're going to value this at market value. So that's just simply saying, first of all, we need to figure out how many shares that is. 20% of 5 million is 1 million. 1 million shares at $30 a share is going to be 30 million. So that's the value, right, of my dividend. And then to do the entry, I'm going to use the par value for the common stock, and the excess goes to additional paid-in capital. All right, so the second question here says, or the third question says, did your entry in number 2 change total equity? Well, looking at this entry right here, you can see from my arrows up and down equity that did not change. No. We didn't change anything in total equity. We just rearranged equity, didn't we? We just moved things from one equity account to another. Did it change the number of shares issued and outstanding? Well, anytime you see a credit to common stock, you know that answer is yes. If you saw a debit to common stock, we have changed the number of shares issued and outstanding. Okay, anytime you see this account in the journal entry, you have made a change to the number of shares issued and outstanding. Did it change the ownership percentage of any individual owner? And here the answer is no. Everybody that owned stock got 20% more. So they got more stock, so everyone's ownership went up in terms of the number of shares they have, but their percentage stayed the same. They stayed the same piece of the action, if you will. Okay, and then finally I just have a statement here about, which is an important thing to think through. It's sometimes referred to as capitalizing retained earnings because retained earnings is our source for dividends. We can only declare dividends if we have positive retained earnings. And by declaring paying out a stock dividend, essentially what you're doing is you're moving money from retained earnings, which you could dividend at some point. You're moving those into permanent equity accounts that are not used to pay dividends. So basically, $30 million, you've just reduced the amount of dividends you could pay out in the future by this $30 million. That's why it's called capitalizing. All right, so that is the small dividend. The next, a couple of quiz questions that just verify the entry we just did. And then the next activity was a 100% stock dividend. So again, is this a large or a small stock dividend? Well, 100%. It's pretty large. 100% stock dividend. So that is going to be a large stock dividend, greater than 25%. If we're doing a 100% stock dividend on 5 million shares, that'd be 100% times 5 million. So this is going to be valued at par value because that's the rule, and it's going to be for 5 million shares. So this entry, we're going to see owner's equity go down by 5 million, and we're going to see common stock go up by 5 million. Okay, a large stock dividend. Did total equity change? Again, you would look at this entry and you'd say, well, no, owner's equity went down and owner's equity went up. Did anybody's ownership change? The answer here again is no. Their number of shares issued definitely changes. Everyone got doubled the number of shares that they own. Okay, so that definitely impacted the number of shares issued and outstanding, but it did not impact retained earning or the total owner's equity. All right, so there's stock dividends.